This is our three-case analysis. I'm Ethan.
I'm Abby.
I'm Christine.
And I am Vincent. Let's jump in.
Jumping right in with our Deutsche Bank case analysis, we boil down our case into two main parts. The first being what caused the decline of Deutsche Bank, and the second being how to become profitable again and compete with other banks. Looking at the graph on the right, we have the decline of Deutsche Bank stock from 2005 to 2019. As you can see, they were growing rapidly up until the global financial crisis, and this crippled them. And even through some ups and downs with quite a few CEOs, they have never really been able to recover. So let's jump right into the next one to see what else caused this. So for major factors in the downfall, as we just mentioned, we have the global financial crisis. Deutsche Bank had been aggressively pursuing investment banking opportunities in the United States. And when the crash happened, they lost all the options they had to invest and turn a profit. And this resulted in a lot of extra slack in the company, as they now had too many employees and their costs were outweighing what profits they could still make. Another factor in their downfall was low European interest rates, as you can see in the bottom right. With the rates dropping, they struggled to invest and expand, as they couldn't maintain a spread that was competitive with other banks while still pulling a profit for themselves. And a third factor in their downfall was from the corruption and money laundering that had come to light. They paid $7.2 billion in fines for mis-selling U.S. mortgage securities and laundering money out of Russia. And over the course of 2000 to 2019, they paid a total of $17 billion. And a fourth factor we identified in their downfall was the CEO turnover. Shareholders were constantly pressuring the bank to turn itself around, but they didn't really give the CEOs a lot of time to do so. And this resulted in a lot of half-baked turnaround plans that never really had enough time to be carried out.
In 2018, when Sewing took over as CEO, he created a business model to help the bank turn a profit for the first time in 4 years. His main restructuring of the bank was to have the corporate bank as the center of the bank, with the investment bank, the private bank, and the asset management on the side, in order to create a more unified one bank, one team mindset. The business plan also created a capital release unit in order to sell off the bank's bad assets and return capital to the shareholders. The bank worked to do this more ethically than they did in 2012, however, by selling off their non-strategic assets rather than their toxic ones. The bank also exited businesses in the reformation process by leaving equities trading and shrinking bond trading. Sewing's plan also reorganized the leadership structure, cut infrastructure, and cut 18,000 staff members. Another effort of the bank's plan is to invest more in technology and distance itself from what they call the antiquated and inadequate computers. While Sewing did propose this increase in technology investment, we recommend that Deutsche Bank focus heavily on this goal. With time, technology and algorithms are increasing in the finance sector and becoming necessary in order to stay competitive and make profits. As technology continues to progress and take over without any sight of slowing down, we find it crucial that Deutsche Bank works heavily and speedily to keep up with the growing technology. Furthermore, we agree that Deutsche Bank has many ways in which they need to reform and restructure in order to be successful. We believe that Sewing and the bank need to work to make the bank more stable. After so much restructuring, CEO turnover, and severance pay that goes along with that, we believe that the stockholders and employees alike are skeptical of the constant changing that is happening within the bank. You can see this through the stock decreasing 5% in 2019 after another restructuring was announced. Overall, Sewing's business plan for Deutsche Bank is logical and respectable, and we believe that what the bank needs most now is stability, and this will come from sticking to the final restructuring plan for the foreseeable future. This will make stockholders less skeptical and more trusting of the bank if they see some stability after years of constant turnover and change.
All right, moving on to our original case study. This is on Robinhood, Reddit, and Gamestop. Specifically, this will be about the GameStop short that occurred, the short squeeze. So to get some background onto what this case is about, on March 23rd of 2020, GameStop stock price closed at only $4.22, but less than a year later, it rose to $347.51. So what caused this drastic change? Well, a short squeeze occurred as a group of Reddit users made posts to buy GameStop stock, so that institutional investors would have to close out their short positions on GameStop at a loss. So let's make sure we understand what's going on here. A lot of institutional investors had sold GameStop short. So Reddit users made posts saying to buy GameStop stock in a large quantities in an effort to make institutional investors have to have a margin call so that they would have to close out their positions at a loss. But how do institutional investors close out their short positions? Well, they have to buy the stock. So that adds further buying. And all of that buying is what caused the stock price to jump so much. So moving on January 28th of 2021, Robinhood CEO Vlad Tenev decided to halt the trading of GameStop stock on his company's app after being notified from the NSCC, which is a clearinghouse, that the company lacked capital to support all of the increased trading. So let's look at our historical GameStop price. You'll see the big jump that occurred around here. That is going from about $4 to over $300. And then, of course, this such an anomaly can only last for so long. So then you see the decline later happening. So what central challenges or decisions does this case bring? Well, first, we're going to see what options did Tenev, the Robinhood CEO, have when he received a letter from the clearinghouse. Also, what does this say about the dangers of global international finance, especially with the advancement of technology? And lastly, what should be done to prevent a similar series of events from happening? To answer the first question, well, Tenev did not really have much of a choice. He couldn't have reasonably anticipated the GameStop short squeeze. Such an anomaly is unpredictable. Second, social media and the rise of fintech enable investors to be swayed by false and misleading information at a much larger scale than before. This really ties into the week's reading on online trading, saying that most people rely on investment advice from social media. Well, that's a big problem because almost anybody can give advice on social media, and often that advice is very misleading and false. And with the rise of fintech like Robinhood, that gives small investors a platform to invest on. So you kind of have a double whammy going on here, where all these people are relying on false information from social media, and they now have the ability to act upon it through platforms like Robinhood. So to prevent a similar series of events from happening, I think there should be more education focused on sound investment practices, along with the dangers of investing based off of social media sites. Sound investment practices are often not taught in general education in America and probably in other countries as well. And I think that it should be something focused on early on. At the very least, it should be focused on how you can lose money in the stock market, especially if you are following blindly advice given on social media. So that concludes the original case study. We will now move on to the Anheuser-Busch case.
So, Anheuser-Busch was basically known as one of the most leading international brewery brands since probably around the late 1900s. They were largely known for their brand Budweiser, and the company was a key player in the US market, which was kind of the key to being the key in the brewery industry at the time. So, in around 2005, Anheuser-Busch started to lose its dominance and started to fall in market share rankings. So, in around 2007, as we see here, Anheuser-Busch has fallen to around fourth place overall in global rankings in regards to market share in the brewing industry, when before it led by a giant margin just a few years before in the early 2000s. So What basically happened was InBev, as we can see, the number 2 ranking, decided to put out an offer to buy Anheuser-Busch on June 11th, 2008. The deal was basically that InBev was going to buy all of Anheuser-Busch's outstanding shares for $65 per share, which was much greater than the current share price, which had not even hit 60 in so many years. So this was a very attractive deal to shareholders of Anheuser-Busch, since it would give them large gains that they would probably not see for a number of years or maybe ever. But Bush the fourth, the CEO at the time, decided to refuse InBev's offer and wanted to come up with ways to fight the hostile buyout instead. So this case ties in with the module topics of cross-border financing from week 9, foreign exchange markets from week 5, and international financial derivatives from week 3, and in particular referencing currency swaps as well as risk hedging. So some of the main issues that this case presents is going to be the issue of the ethics of the alcohol multinational corporations and their marketing and advertising methods, since this industry does cause a lot of the bigger health issues that we see in consumers, such as cirrhosis or liver disease, and also, in addition, marketing to young people whose brains are not fully developed yet. It can be dangerous and have lifelong effects. So another one of the issues that this case brings up is the risks of cross-border financing. In Anheuser-Busch's case, this basically means their exports of their goods into foreign countries. And this can cause issues such as political risk as well as currency risk, which we will be focusing on. So in regards to the recommendations for this Anheuser-Busch case, we recommend that Anheuser-Busch take InBev's offer, since this decision would be consistent with shareholder wealth maximization theory, because InBev's offer, as we said before, would be $65 per share, which is much larger than any share price that Anheuser-Busch has seen in years. So it would be in the shareholders' best interest for Bush the fourth to take the offer. And then also in that, we would recommend perhaps using the services of an investment bank and investment bankers in regards to a deal like this to help Anheuser-Busch come up with the best possible deal that they can in regards to this merger and acquisition, or perhaps buyout in this case. And then in the regards to the issue of alcohol and ethics of these multinational corporations or big alcohol, the recommendation is that these large alcohol companies should be quite clear and upfront about the harms that their products may cause to consumers, especially towards younger adult consumers, and they should give consumers the full picture about alcohol products, given that there are some serious lifelong diseases that one could contract or get from overuse of alcohol products. So in regards to cross-border financing risk, or in this case, we're focusing on currency risk, we recommend the implementation of financial derivatives, in particular currency swaps. So as we can see here in the figure, currency swaps make up more than around a quarter of the foreign exchange contracts seen in 2017 all the way to 2019. So this shows that these contracts have a lot of liquidity and therefore would be an ideal hedge for Anheuser-Busch to use in case they'd like to liquidate or trade them. It would be very easy given the high number of contracts traded. So finally, we are going to end our presentation here, and thank you for watching.